The economy didn't break overnight. It was broken deliberately, one decision at a time. And now, the bill is arriving. All at once. Washington thought it was playing chess. It turns out it was dismantling the board. The tariffs, the sanctions, the tech bans, the arms sales to Taiwan, each one looked like a power move in isolation. But string them together and you get something else entirely. You get a country that has systematically provoked the world's second largest economy, the world's largest manufacturer, and the single biggest holder of US debt, all at the same time, while its own stock market was sitting at valuations that had no margin for error. That is not strategy. That is a ticking clock. And now, the clock is going off. Nasdaq futures are down. The S&P is bleeding. Small cap stocks, the ones that live and die by domestic credit conditions, are getting hit the hardest. And Beijing hasn't even made its biggest move yet. This is just the opening pressure. The real question isn't whether this hurts. It clearly hurts. The question is how deep the wound goes and whether Washington has any real tools left to stop the bleeding. Let's start with what actually happened. Because the headline, "China cracks down on Washington," sounds dramatic until you understand the mechanics. Then it sounds terrifying. The US Supreme Court ruled that Trump improperly used the International Emergency Economic Powers Act to impose sweeping tariffs on China. That single ruling didn't just block a policy. It pulled the legal foundation out from under Washington's entire tariff architecture. In one decision, Beijing's leverage doubled. The pressure that Trump had been using to squeeze China into buying more American soybeans, Boeing planes, and energy products. That pressure just got a court-ordered ceiling put on it. And China's Commerce Ministry responded almost immediately, calling on the US to eliminate all unilateral tariffs. That's not a request, that's a position. And it's coming from a side that just watched its opponent lose its biggest weapon in front of a referee. Meanwhile, the US trade representative was simultaneously insisting that Trump wants to keep tariffs steady at 35% to 50% on Chinese goods. So one branch of the American government is saying tariffs are here to stay, and the judicial branch just said they can't be imposed the way they were. Washington is now arguing with itself in public, in real time, right before a high-stakes summit with Xi Jinping scheduled for late March. Markets are watching this. Investors don't price in certainty, they price in the absence of it. And right now, uncertainty is the only thing in abundant supply. Here is what makes this moment structurally different from every other US-China tension spike of the past decade. In every previous episode, the market had a safety valve. The assumption was always that both sides would blink, that the economic interdependence was so deep, so entangled, so mutually expensive to destroy, that rational self-interest would eventually pull everyone back from the edge. That assumption is now being tested in ways it never was before. And it is starting to show cracks. China is no longer just responding to US pressure with counter-tariffs. It is using a completely different toolkit. The anti-foreign sanctions law, enacted years ago and used cautiously at first, is now becoming an active weapon. Beijing sanctioned US defense companies involved in arms sales to Taiwan. It issued warnings to American corporations operating inside China. It signaled that export controls on rare earth materials, the minerals that feed American semiconductor production, defense systems, and the entire green energy supply chain, are very much on the table. These are not symbolic gestures. These are pressure points chosen with surgical precision. aimed directly at the parts of the American economy that are most exposed and least replaceable. Think about what rare earth dependency actually means in practice. The US cannot produce advanced semiconductors without rare earths. It cannot build the F-35 without rare earths. It cannot manufacture electric vehicle batteries at scale without rare earths. And China controls roughly 60% of global rare earth mining and around 85% of processing capacity. That is not a trade detail. That is a structural choke point. When Beijing signals it might restrict exports of those materials, it is not threatening Washington with an inconvenience. It is threatening to freeze entire American industries mid-stride. Write in the comments. Do you think Washington fully understands what it has exposed itself to? Or is this strategic blindness? Tell us what you see. The stock market reaction is not irrational panic. It is correct pricing. When investors see a country that has outsourced critical supply chains to its primary geopolitical rival, then picked an escalating fight with that rival while its own courts are dismantling its tariff powers, the logical response is to reprice risk, not slightly, significantly. The companies that get hit first are the ones with the thinnest cushions, small American businesses that borrow short-term, sell domestically, and have no hedge against rising input costs. Their profit margins don't survive a simultaneous hit from higher borrowing costs, supply chain disruption, and falling consumer confidence. They don't have war chests. They have credit lines, and credit lines get expensive very fast when the risk premium on the entire market starts climbing. But the pain doesn't stop with small caps. The giants are exposed too, just differently. Apple manufactures most of its hardware in China. Tesla sells a massive share of its vehicles in China. Nvidia's revenue model depends on chip exports to Asian markets, including Chinese data centers, even under the current export control regime. When China's economic relationship with America deteriorates, these companies don't just face softer demand, they face a structural question. What happens to the business model when the two largest economies in the world are actively trying to decouple? That question has no clean answer. And every day, without a clean answer, is another day of discount applied to future earnings. This is where the energy dimension comes back in and makes everything worse. China imports roughly $500 billion in oil every year, and more than 40% of that comes from the Middle East. The US military operations in the region, regardless of their stated objectives, directly threaten those flows. When the Strait of Hormuz faces any degree of disruption, China feels it immediately and proportionally. Brent crude jumping 30% above $80 per barrel is not just an energy story for American consumers at the gas pump. It is a cost shock that reverberates through every Chinese factory, every shipping route, every manufacturer of goods that eventually ends up on American store shelves. The inflationary loop runs in both directions. When China's production costs rise because of disrupted oil supplies caused by American military policy, the prices of goods imported into America also rise. Washington is effectively taxing its own consumers through the back door of geopolitical conflict, and the Federal Reserve is trapped. If inflation climbs back above target, driven by energy shocks and supply chain disruption rather than demand, the Fed cannot cut rates without appearing to abandon its mandate. Cutting into inflationary pressure is politically toxic and economically reckless. So, rates stay elevated. Elevated rates mean expensive credit. Expensive credit means the refinancing woe that corporate America needs. The one that was supposed to happen when rates finally came down doesn't happen. Companies that took on debt at low rates during 2020 and 2021 and have been waiting for relief are now staring at a wall. Some of them will not make it over. This is the feedback loop that makes the current moment genuinely dangerous. It is not one shock, it is a convergence of shocks that all point in the same direction and have no obvious release valve. Now let's talk about what China actually wants, because Beijing's strategy here is not reactive. It is deliberate, patient, and structurally coherent in a way that Washington's current posture is not. China's leadership has concluded, and has said so internally, that America is in accelerating decline. Domestic political dysfunction, fraying alliances, military overreach, judicial contradictions on trade policy. Beijing reads all of these as symptoms of a system under strain. And China's foreign policy in 2026 is explicitly calibrated to exploit that strain, not to provoke a direct confrontation, but to widen the cracks, accelerate the contradictions, and position Beijing as the steady hand while Washington looks like it is arguing with itself. That is a sophisticated play, and it is working. The April summit between Trump and Xi in Beijing is shaping up to be one of the most consequential diplomatic meetings in decades. Trump is going in with weakened tariff authority, a stock market under pressure, a Middle East operation with an undefined endpoint, and an election year audience that is already feeling the cost of higher prices. Xi is going in with a Supreme Court ruling in his pocket, a currency that has been quietly appreciating against the dollar, and a trade relationship where China controls more of the inputs than America does. The leverage map has shifted, and financial markets are beginning to price that shift in real time. From where you're watching this right now, drop it in the comments. We want to know which country's viewers are seeing this unfold closest to home. The currency layer matters more than most people realize, and it is moving quietly beneath the noise of tariff headlines. The yuan has strengthened more than 6% against the dollar since 2010. That might sound like a small number until you understand what it means structurally. A stronger yuan means that every dollar of debt China holds loses relative purchasing power. It means Chinese companies can import commodities, including the oil they desperately need, slightly more cheaply in yuan terms, and it means that trade partners who deal primarily with China have a growing incentive to settle transactions in yuan rather than dollars, not because they love yuan, because it's practical. The invoicing currency follows the trade relationship, and China is now the largest trading partner for more countries than America is. This is where the petrodollar narrative starts to fray at the edges. Saudi Arabia, the UAE, and Iraq are not going to formally abandon dollar-denominated oil pricing tomorrow, but they are all deepening trade ties with China. They are all participating in Chinese-led multilateral frameworks, and every major purchase of Chinese goods, every Belt and Road infrastructure deal, every swap line agreement between the People's Bank of China and a regional central bank is a small withdrawal from the account that keeps dollar dominance funded. The dollar doesn't lose reserve status in a single dramatic moment. It loses it the way a glacier melts, slowly, invisibly, and then suddenly, catastrophically, all at once. The market signal that should alarm every investor watching right now is this: the dollar is not behaving the way it should in a crisis. In a normal geopolitical shock, capital floods into dollars. Investors buy US Treasuries as the safest asset in the world. Yields compress. The dollar rises. That is the playbook from every major crisis of the last 50 years. But it is not what is happening now. The dollar is underperforming. Treasury yields are not compressing cleanly. Capital is not flooding in with its usual urgency. That is not noise. That is a signal. It says the market is beginning to question whether America is still the clean, safe haven during a crisis that America itself is generating. When that trust erodes, even slightly, even temporarily, the consequences compound. Foreign holders of US debt start demanding higher yields to compensate for the perceived risk. Higher yields mean higher borrowing costs for the US government, which is already running trillion-dollar deficits. Higher government borrowing costs crowd out private investment. Less private investment means slower growth. Slower growth means more deficit spending. It does not reverse easily. It does not reverse easily. The Afghanistan parallel is worth sitting with seriously. Direct budget costs of that war reached $2.3 trillion. Factor in long-term healthcare for veterans, interest on borrowed funds and broader economic disruption, and the total bill approaches $8 trillion. That number was not visible on day one. It accumulated over 20 years of decisions that each seemed manageable at the time. A military operation that doesn't end cleanly in a region that sits directly on the energy flows that power the global economy, with no defined exit criteria and a stated timeline of potentially 4 weeks or more. The financial tail on that is not short. Every additional week adds another layer to a cost that is already being borrowed in real time from America's long-term fiscal capacity. Markets can absorb a shock. What they cannot absorb is a shock with no defined endpoint and no clear exit. Uncertainty does not get priced once. It gets repriced every day. The clarity is absent. Every morning, the traders look at the headlines and still cannot answer the question, when does this end and what does the end look like? That uncertainty goes directly into the risk premium embedded in every asset price. Stocks, bonds, commercial real estate, corporate credit. Everything that was priced for a relatively stable future has to be repriced for a future that is demonstrably less stable than it was 3 months ago. Here is the scenario breakdown that actually drives financial decisions, because there are really two paths from here, and they have very different implications for markets. The first path is a negotiated de-escalation. Iran agrees to nuclear talks through the Oman back channel. Washington accepts a deal that looks like progress on the nuclear file. The Middle East operation winds down within the stated timeline. Oil retreats. Inflation expectations ease. The Fed gets room to cut. The April summit with Xi produces a tariff framework that both sides can live with. Markets recover. The stress is real but contained. This is the scenario that lets asset prices hold at something approximating current valuations. The second path is structural escalation. The operation in the Middle East extends beyond its stated timeline because the actual objective, regime change or permanent disruption of Iranian energy revenue, cannot be achieved on a political schedule. Oil stays elevated. Inflation proves sticky. The Fed is paralyzed. The April summit with Xi produces no real agreement because Beijing has calculated that waiting is more advantageous than conceding. China begins quietly accelerating rare earth export restrictions. American companies with China exposure face simultaneous demand shocks and supply chain disruption. The deficit expands. Treasury yields rise. The dollar continues to underperform its crisis role. And the market, which has been trading on the assumption that everything is fundamentally fine, finally confronts the gap between valuations built on optimism and a reality built on structural fragility. The second path doesn't require a catastrophe. It just requires nothing to go right. And right now, very little is going right. The energy stocks are the clearest winners in this environment, and that fact alone tells you something about who benefits from the current configuration of risks. American oil producers gain from elevated crude prices, defense contractors gain from elevated military spending, logistics companies that operate outside the disruption zone benefit from rerouted trade flows. The financial pain is not evenly distributed. It is concentrated in the sectors and populations that are least equipped to absorb it. Small businesses, consumers with variable rate debt, countries whose energy imports run through choke points that American policy is now actively destabilizing. The strategic picture, stripped of all its diplomatic language, is this. Washington is using military and economic leverage to control the flow of energy and technology in ways that directly threaten China's growth model. Beijing knows this. Beijing is responding not with panic, but with patience, quietly accumulating leverage, waiting for the court rulings and the fiscal pressures and the political constraints to do their work. The April summit is not a resolution. It is a checkpoint in a longer game, and in longer games, the side with more patience and fewer domestic political pressures to show quick wins usually has the structural advantage. Do you think the United States can still reverse this trajectory before the financial damage becomes self-reinforcing? Or has the window already closed? Write your answer in the comments. The story from here depends on two things that no one in Washington has given a straight answer on yet. First, what is the actual endgame in the Middle East? A verifiable nuclear agreement, a compliant new government in Tehran, or a permanent state of managed destabilization that keeps Iranian oil off the global market and away from Chinese refineries? Second, what is the real offer on the table for China? A durable trade framework built on mutual interest, or a temporary ceasefire that buys time while the economic pressure continues to build? Until those questions have answers, every asset price in the world is carrying an uncertainty premium that nobody can quantify. Markets don't like what they can't quantify. And what they can't quantify, they discount sharply. The edge that America is standing on right now is not a dramatic cliff. It's a slow incline that gets steeper with every unanswered question, every additional week of military operation, every court ruling that removes another tool from the foreign policy toolkit, and every day that the dollar fails to perform its traditional safe haven function during a crisis it helped create. The next few weeks don't just shape headlines, they shape the architecture of global finance for the decade that follows. Watch closely, because the bill is still being written.